You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always. This is the first week of FY26, and what a 25 we had. I can't believe we are starting this financial year with a stock on market number below 4,000 properties on the market. There is not a person in Western Australia, expert or punter, who suspected at Christmas time that the amount of properties on the market now would be less than it was then, and that it would be less than 4,000 properties on the market. It is blowing our mind that we are back in FOMO territory statistically in the Resi space. You're seeing it on the ground, and with rate cuts due tomorrow, we expect the kerosene is certainly being thrown on the fire, and the expectation of that has already started to set in with regards to the lack of stock coming on the market, despite every effort from private developers and the public sector. So the reality is we're looking forward to another year of, unfortunately, an undersupplied, chronically undersupplied market with constant demand coming from population growth that sustains itself over and above the capacity we have as a state to supply property, new property that is, in the marketplace. Don't expect much of it to come out of the apartment space this financial year. Don't expect more than 20,000 of them to come out of the land development space. And as long as we keep importing more than 50,000 people a year, we'll keep creating deficits in our supply in the property market. So price growth becomes the outcome for us again in Western Australia. Prices will continue to rise based on increased affordability artificially coming from lower interest rates and that demand-supply relationship referenced. One man who is someone I look up to in this industry, who is an expert in his field and is working across a number of segments in the nation's property market these days, and was one of the most insightful conversations we've had in our 354 episodes to date, is Cal Doggett, Managing Director of Properties and Pathways. He's a new dad recently and is suffering from sleep deprivation like everyone who goes through it, but is very kindly in the studio this morning to have a conversation with me about where the market sits from a commercial and resi space and some of the impacts coming out of the massive increases in the cost of construction as well. Mate, thanks for coming in.
Trent, thanks so much for having me. I'm flattered to be here, mate.
Let's get straight into it and get an update quickly from you. It's been 105 weeks, by the way. Your last episode was episode 250. And we're at 355 today. Wow. 2 years, essentially. What's been happening in the properties and pathways side of things? When we first met in June 2023, it was really a conversation about how you'd been killing it nationally in the refurb and flipping of commercial and industrial assets around the country. How's the world been in the last couple of years?
Look, it's a fantastic question. I think at that time, Trent, we had just done a pretty decent divestment of our industrial portfolio. And the question was like, geez, what do we do now with this money?
Rates were increasing or were rapidly increasing at the time, which has big impacts in the commercial industrial space.
Oh, absolutely. Geez, your bottom line can be enormously impacted by rates, cash rates, but also swap rates. And then, look, we had recently done a pretty decent dip of toe into the residential market. And I actually joked at the time, I think in that podcast, I said, for all the commercial property we've done, I think this residential play might be the most profitable investment that we'll end up creating for our investors. And I think fast forward 2 years almost, and here we are, I think it's playing out that way. And it goes down almost entirely to that demand-supply dynamic you talked about at the start of the session. In WA, it is completely a market that is being determined, or prices are being determined by demand and supply. That's those two elements are in a constant fight with each other. And you've mentioned there's a complete undersupply right now. Doesn't look like construction's going to keep up. We've got imports of people, like scary numbers. And so as a holder of residential property and as a holder of commercial property right now, we're sitting very happy. If I were to try and enter the market right now, it's difficult, really difficult. Where do you best leverage your time to get into a market or get into an opportunity that's going to create value for investors? It's a really tough question.
Can you explain to me how that impact of demand and supply is different in your relationship to it between commercial and industrial in that space and what you've experienced in the last couple of years in Resi. What's the difference?
Yeah, I think in the commercial space, there's probably a little bit more open-mindedness and a more of an investor-centric mindedness. If you're buying a commercial asset at a capitalization rate or yield, let's call it, of 6 or 7%, and your cost of debt's at 4% or 4.5%, there's a delta there, right? And you can create an outcome for yourself with that delta. Most of the people in the commercial space are investment-minded. They're buying it to enjoy a return. They're buying it to enjoy an annuity of income. Flip that to residential and you take on a very emotional context now because people are buying houses to live in a lot of the time.
You can't live in a warehouse, can you?
No, exactly right. And then you go and you look at people. Some people are in a house they're living in. They don't want to move, but they're looking at the residential market around them going, far out, this thing's getting really hot. How can I make money out of this without selling the house that I live in or without having to move? So the whole dynamic there is very different. Whereas we might see people trade in and out of commercial property in WA. You might see that once in 10 years if you're lucky. Now in Queensland, you might see people trade in and out of commercial property twice in 10 years. But in Resi, at the moment now, we're seeing some investors trade in and out of property 10 times in 10 years. So I think the liquidity of the residential property market allows more of a speculation a little bit from the investor minded. I also think it's more damaged by construction prices than commercial is at the moment. And I suppose the shortage of construction availability, that's a dynamic that's a little bit different.
Well, construction in itself, the whole contractual space between building a Resi home or Resi homes in a Resi development versus building/refurbing a commercial premise is totally different as well.
Yes.
When you think about the professionalism, the liquidated damages, the supervision, all those things is just so different between a Australian standards contract and a HIA contract.
Oh, absolutely. Yeah, look, and it can be fraught with danger if you get it wrong. Look, you're so right, Trent. I suppose what we're lucky about is that our normal landscape's commercial property. When we look at residential then, we're able to take this really macro view of it rather than getting distracted in the detail. Like macro view of residential is that in 2014, it took you about 8.5 months to build a house, right? Now, 2024, it takes you 12.7 months to build a house, national average. In WA, it takes you 17 months to build a house. So we look at that as a macro level and go, that's got to create some kind of movement in demand or supply. And what's the lever that ends up getting squished? It's price.
Yeah, it creates friction.
It creates friction. We're lucky in that we're afforded a bit more of a macro view, but now that we're invested in the residential space, it's okay. Now we're experiencing things that are happening on the ground on a daily basis, like how long it takes to get approvals, how long it takes to get the council to even look at an application, like the costs of going through an approval process for a subdivision, or how can we change the zoning to allow greater density, like all these things that are actual issues in the residential space right now, that because we own them, we're experiencing it all and we're going,
asking all these questions.
Yeah, this is really difficult. This is not an easy environment to play in. And we're lucky enough that the market levers are still playing out and that prices are still rising. But if all these dynamics were happening and prices were stagnating, we would be far more worried. If all these dynamics were happening and prices were dropping, we would be in dire straits right now.
You wouldn't be in the Resi space at all. And that leads me to the question I have to ask, which is one that people are probably asking themselves listening to you. You are a bona fide expert in the space you spent so many years in. Why did you move and take a jump, or at least start to diversify some of that portfolio into a space that you have said yourself aren't as much of an expert in, or at least weren't when you started making that move?
Yeah.
What pushed you into? Was it just the situation with regards to rates, refurbishment, construction costs, to have been something that pushed you out of a place that was quite lucrative for you for a long time?
I think it comes back to our investment philosophy. We believe that what it is to be an investor is to not be loyal to any one asset class. So yeah, we're experts at commercial property and it's been fantastic to us and has delivered good yield and great returns to our investors. But if we look at the 15-year journey we've been doing that, we've been averaging about a 20% return to our investors. But if, when we started in 2012, I could have put my money in the bank and got a 15% interest rate, I would have just done that.
Yeah, based on risk, it's a pretty good outcome.
Exactly. So you've got to look at, like, any investment now is only as good as its relationship to other potential investments. It's that opportunity cost we talk about. So when we divested a huge amount of our industrial and commercial portfolio, rather than just going straight back into the game we'd come off, we just took a step back and said, if we're not loyal to this, where are some other avenues of potential growth or potential X factor returns that we should be looking at, or at least considering? And look, the dynamics at that time in the Resi market in WA were pointing it to a really fantastic story. And we had a very loyal investor base that were brave enough to follow us in. So it was the ability to look beyond just the asset class that we're experts in. And Trent, I've said this before, but we relied really heavily on experts like yourself to leverage our position into the Resi market in WA, because if we didn't know it all, we needed to really make sure that there were friends and there were trusted networks around us that we could jump on the backs of these giants and actually enjoy a safe landing into investing there. But that was the reason why we made that move, is because we thought, hey, right now in a bank you're getting maybe 3.5%. Commercial, we divested a whole lot because we didn't see capital growth continuing. And then we looked at the Resi and we thought, wow, if what we think is going to play out here plays out, this could be astronomical returns, like triple-digit returns in 2 or 3 years.
And it's interesting that you speak to that, because what it speaks of is not a property investor per se, especially one we know who, for the most part, do stick to their lane and just rinse and repeat. It's a funds management model. You're managing people's funds. It doesn't matter if it's commercial, if it's a Bunnings warehouse, or if it's a house in Balga.
Yeah.
The focus is just balancing risk for reward.
Yes.
And as long as we're in a space that we've got a foundation in, and we're not moving into crypto or fine art, where we clearly have minimal context or the risk for reward can't be quantified as well, then it really shouldn't matter what it looks like at the end of the day, as long as you've got access to that opportunity. And that's where you speak about access is, and I speak to this podcast all the time on it, is having a team around you. Yeah. Even when you're Cal Doggett, you aren't just doing this all yourself. You're relying on people who are maybe better than you at specific niche things along the way to help you get to that outcome holistically of managing funds, which is what Cal Doggett does.
Yeah, it's an interesting position that I've found myself in. I accidentally ended up here. But what's really interesting about what you just said is the team around you. And if I look at the team I've got around me, fantastic individuals, but out of a 12-person team, only 4 of us are property minded. And we listen to everyone in our team about what they think about our investments. So like my fellow directors are not from property backgrounds, but when we look at our next investment opportunity, our next investment avenue, we've got a diversification of thought in the room. So it's not just, let's rinse and repeat. It's like, can we test the assumptions around why we entered that market? Did it work? Did it not work? Can we test the assumptions around why we're entering this next market? Is it going to work? Is it not going to work? And I think, as you said before, there are investment avenues outside of property, which I would be very reluctant and very scared to venture into. But I think if you are going to take like a funds management approach, you need to be disloyal to any particular investment class. And we try to do that as much as we can. Obviously, if it's backed by land, we really like that. We think land depreciates over time. The movement from commercial to Resi was probably a more palatable move than trying to take investors' money and say, hey guys, let's go buy shares. Yeah. It was a bit more foreign to us.
So in light of that, we don't want to generalize at all, but is it the case where you've made a decision in your team that commercial doesn't have the opportunities it wants? Is it a reality that's been ongoing for the last couple of years? Do you expect that to continue compared to Resi? Where does it sit on the hierarchy right now for you? Is there still an opportunity for you to look on realestate.com and go, hey, that commercial one, we wouldn't mind going after that? Or is it just sticking to Resi right now?
No, look, to the contrary, we're still very much looking at assets in the commercial space.
Hoping that they make sense?
Yeah, and look, we kiss a lot of frogs. We've seen a lot of assets and we go, look, that's just not going to work. And it's interesting that if we use the same assumptions we used 6 years ago or 5 years ago, we're like, that would have worked. But the assumptions now are just slightly different. And we go, I don't think it produces a good enough risk-return ratio for us. And so at the moment, Resi's been really great.
It is so simple, right? And that's the benefit of Resi. In the most case, the market itself, if you can understand it, is a pretty simple one. It's why it's mainly filled with mum and dads. And the commercial space, whilst at the end of the day, once you understand it, is very simple. It's quite a complex space to be in too.
It can be.
I guess Resi, what you're saying in a way is that if Resi can stack up, why not?
Oh, absolutely. And we don't see the heat coming out of the WA market anytime soon. Why would you take your position off the table if that's the case? I think there's probably 12, 18, 24 months of sustained growth here. Now, we wouldn't want to miss that peak. We'd probably want to get out before that peak if we're right. We could be wrong. But it doesn't mean we're not looking at opportunities in commercial or industrial, or we've even looked at things like some development more recently. We've looked at some high-rise.
So what's the landscape? What's the current market update from Cal Doggett on that sphere? Where are you looking and going, there's something here versus, no, we're still seeing nothing?
It is difficult. The short answer is that we've we look at hundreds of assets a week, and we're saying no to hundreds of assets a week. So that's the reality. The ones that we say yes to are actually really simple in nature. So for instance, I'll give you an example. Right now, we know that in Queensland, there is an enormous amount of infrastructure going up because of the Olympics in 2032, right? And there's a huge amount of construction and building going on there. But in order to meet the demands of the Olympic Games in 2032, like 94% of the construction workforce is tied up in public sector infrastructure. So if you want to go build a retail showroom right now, okay, you might be able to get it done now. But as we get closer and closer to the Olympics, the availability of trades is going to be genuinely next to zero. So what does that mean? If you're not going to be able to construct a retail showroom, then the current retail showroom has to start demanding a higher rent. And we look at that and go, if we can take a premises now with a 4-year or a 5-year lease, then by the time that lease comes up, we're banking on the rental rate being far higher because of that same demand-supply ratio we talked about. No supply coming online because all the time is being spent in public sector
building
infrastructure.
Stadiums.
Exactly. So, we look at that and we go, that's a very simplified way of looking at something pretty complex, but sometimes dumbing it down makes it really easy.
Has that been the case in WA with Metronet and the hospitals and the port stuff? Like, is that essentially the same outcome?
It is. And I think WA to a certain extent is even worse, but we're not on a global stage having a Olympics here. But what's interesting now is that just in the last 6 months, we've seen legislative and council change in Queensland to enable a fast tracking of developments and a fast tracking of construction. So they're relaxing themselves in terms of environmental and heritage concerns to try and move through construction quicker, right?
So they don't end up having an embarrassing debacle in 2030.
Like exactly, Trent. So they're making moves now that I think are necessary, and they obviously think are necessary, so they don't embarrass themselves on a global scale. But the only thing that'll happen there is embarrassment. In WA, you've got actual homelessness as an issue, but no one's willing to make the moves necessary to fast track and move through all the red tape to construct and create the density we need and create the houses we need.
We know that there's a review that's been mooted by Minister Kerry of the R codes, but that will take years. And then the outcome of that will take even more years in terms of what gets built out of it in a more laxed environment.
Yeah.
And again, it speaks to another reason why we aren't, in my opinion, solving this problem, and of the HIA's opinion, solving this problem before 2030. And if you can't solve for the supply problem, as long as demand doesn't fall off a cliff because your economic activity's gone or because people just don't think Perth's a good place to live in anymore, which obviously I don't think is a reality, then you can't really, in my opinion, put up an argument for growth that doesn't have a positive symbol in front of it until we do fix that problem.
Yeah.
Whereas with commercial, I guess it's far more sensitive to interest rates, which are mooted to keep going down, which helps your space there in terms of getting people interested in an investment with a yield higher than the interest rate, which has been hard for a couple of years because the interest rate's been the same as the yield for most assets, right?
Yes.
But also then construction costs start to come in as well, as you were speaking to as well, and that really does start to affect commercial property in a similar way to how it's affected, and we know it's affected the Resi space. And a great way to explain the Resi space is, and I think I've spoken to this, Ellenbrook's a really good example. 5 years ago, you could buy a house in Ellenbrook for 400 and a bit grand. That was 200 and a bit $1,000 of land and 200 and a bit $1,000 of a house replacement cost at the time.
Sure.
Now, that land would cost in the high 300s, and it would be at least $400 and something thousand to replace that 4x2 house in Ellenbrook.
Yeah.
And so that replacement cost theory of, well, if I had to knock it down tomorrow and replace it, or if the land was empty next door and I had to build it, it would be in the high 700s to 800 grand, starts to come to the fore and has been the reality for pushing the established market along over the last few years, even in areas where amenity hasn't improved, where if you compare it to the commercial space, the trading situation hasn't improved, the rent hasn't improved. But that's where you start to see it come in the commercial space as well. As construction costs get higher or land costs get higher, yields have to come down to make new supply come on. Otherwise, new supply doesn't come on. You see it in childcare, for example. You've got a Nido in Perth that trades at 6%. That same Nido in Sydney would trade at 4 and a bit %.
Absolutely.
It's the same asset.
Yes.
With the same tenant.
Exactly.
The same lease. Why? I mean, there's no way that this asset is 60% more risky than the asset in Sydney.
Yeah.
It's a reflection of how did we get there in the first place.
Yeah.
How are you seeing that impact commercial situations with regards to rents, with regards to leases, with regards to construction costs, and getting the next KFC off the ground in WA, for example?
Yeah, that's a fantastic question. And you know what? I'm just thinking out loud here, but the reason why the commercial game probably hasn't been as impacted yet is because of the length of the leases. So if you think about why investors are looking to invest into residential, it's for capital growth, right?
So speculating that their house will be worth more next year than this year.
Absolutely. Now, in the commercial game, you're usually purchasing a yield, as in you're looking for the cash flow. There might be capital growth on the back of that, but really, you're typically buying it for a yield. And that yield is only there because of a lease that's in place. And because the lease is in place, you cannot move the rent during that lease. Only when the lease comes up or an option gets exercised would you review that rent to market.
So the value only changes on yield.
Exactly.
Not lease.
Exactly. While the lease is in place. But great example, if we extrapolate that, let's say you're in Joondalup now and you're in secondary retail location in Joondalup and you're charging $230 a square metre to rent and you've got a 5-year lease. Meanwhile, construction prices are going up, okay? So to build new buildings...
It's not happening.
Exactly. Joondalup's pretty landlocked. But let's say you want to build a new retail showroom in Joondalup. And in order to do that, you're spending way more money than you would have 5 years ago. So in order to rent it, you have to rent it at $350 a square metre, okay? That means nothing to me while I've got a 5-year lease in place.
Yeah, you're sitting pretty.
Exactly. I'm sitting pretty, but I'm also sitting pretty below the new rental rates that are being achieved. So what it's showing is that there could be a time in the commercial market right now where it looks fine. It looks like it's all above water, but the tenants are about to experience what I think is going to be an astronomical improvement in rent because in 5 years...
For the landlord, not for the tenant.
No, exactly. The tenant's going to be going, what the hell?
Yeah.
And the landlords are going to be licking their lips because in 5 years' time when that lease comes up for renewal, now the going rates are 350, 340, 350, 360. But while their lease has been in place, they're being protected from it. Insulation.
Really see it. Yeah.
Exactly. So what I think we're seeing now is like in the Resi space, it's sensitive to those movements on a daily basis. You can see it and feel it. You can sell a residential home in 30 days. It's so dynamic and you can see those movements genuinely on a daily basis. In commercial, it sounds like while the lease is in place, it's like, what's the impact?
So it's chunky.
Exactly. So when the lease comes up 5 years, 6 years, 7 years down the track, that's when we're going to start seeing pain in that sector. And as a result of the same thing, undersupply of availability for construction, and which is going to cause an increase in rent. In the residential game, it would be an increase in price. In the commercial game, it's an increase in rent.
The reality for the commercial space is that over the last 2 or so years since we spoke on the podcast, we've seen not only yields going up, which sends values down.
That's right.
But also construction costs going up,
yeah,
which makes it harder for things to work. So developers look at that and go, hang on a sec, if this thing is going to be worth $5 million to a family office who might buy this off me, but it's going to cost me $2 million to buy the land and $3 million to build it now instead of 1.5 and 1.5,
yeah,
then I'm not building it.
Exactly.
And so nothing happens.
Yes. Yeah.
Then you start to see, for reasons totally third party to that, yields start coming down again because of interest rates, not because of the specific market conditions in the commercial space. Then there starts to be a bit of a gap opening up and people start to have a conversation again about, hey, maybe we can create some supply in the commercial space. But as I guess we're alluding to here, it's after years of nothing.
Yes.
And so you start to see a reset. And if I'm going to do it, the rents now have to be 50% more because, yes, there's a little bit of yield compression, but that's not getting me out of my bed to actually build this next KFC or Macca's or whatever it might be.
Yep, you're exactly right.
And that's hard. That's friction again because the tenant looks at that and goes, mate, I'd never paid $300. Why would I pay now? And you go, well, if you want one,
yep,
that's what it's going to cost.
All right, and so what you'll end up seeing is that there will be a greater component of developers in the commercial space moving to speculative development activity.
Which is what we've seen in the industrial warehouse workshop space in the last few years.
Exactly. So where they're saying, look, I don't have a tenant before I construct, but I'm so convinced that the rent's going to be higher, I'm going to construct it on spec.
And I'm not locking it in now.
No, exactly. But then you think, okay, what's the flow-on effect of that? In order to get a bank to finance that, it's very difficult.
Yeah, a lot more equity has to go into it.
A lot more equity. But then what we're seeing now, there's been like a 40% increase in non-bank lending for commercial assets in the last 5 years.
That's very insightful. I've seen it as well. Because the banks as well, their risk profile continues to retreat simply to the family home.
Yes. It does. And banks need to lend money, right? That's their business. But they need to lend money that they know they're going to get back. Yeah. So it is safe to go lend money for the mortgage on a home loan. In the commercial space, to lend money on a construction that hasn't got a tenant at the end when it's complete is very risky business. But the non-bank space, as we say, is growing at a rapid rate. And interestingly, a lot of the competitors that I have in terms of acquirers and sellers of property are moving more into debt because they're looking at it going, the equation here is I could take a position not in the equity, but in the debt on this development. And if it all goes belly up,
I get it anyway.
I get it anyway.
Yeah.
And what a fantastic position to be in.
No, you're right. I've seen this as well. And behind closed doors, there are a lot of big developers who are actually the financiers of other developers.
Indeed. Yeah.
What an interesting span. I haven't actually spoken to anyone about that, but I assumed it just spoke to these guys have made that much money. They don't know what to do with it. They're just backing in other people.
Yeah, and they're backing in other people, but I think there would be a few financiers out there that would be hoping that the actual development feasibility falls in a heap.
Where there is chaos, there is opportunity, Cal.
Yes.
Where do you see the opportunities over the next couple of years for yourself? We come back on this podcast in hopefully not 2 years, but let's say we do.
Yeah.
What will you have had been focusing on in 2026, 2027 financial years?
The short answer to that, Trent, is that I think we will be actually divesting quite a lot of our positions. In the syndicated game, you need to give people their money back.
Yeah,
you need to have an exit. There is. And look, if you set out to do a 5-year term or a 6-year term or a 7-year term, maybe you can extend that to 8 or 9, but you can't extend it to 20.
Yeah.
People need their money back. So because of, I suppose, particular buying sprees, we'll call them, or opportunities where we entered the market really aggressively, there comes with kind of lumpy divestments. And so we think we'll be divesting quite a few of our assets over the next 18 to 24 months.
But as a funds manager, you'd like to be able to roll that back into something else.
Tell me about it. It's like the question we ask ourselves the most within our 4 walls is like, geez, we're doing the right thing by the investor group here, and we're an investor in all of our syndicates as well. We always put our money behind them. But you go, as far as running a business goes, it's pretty difficult to run a business when you haven't got assets under management. But we still think, let's do the right thing by the investors. The next opportunity will come. We've got to keep open-minded enough and humble enough to know that it may not be in an area that we have expertise in. I think that's really important. Yes, we've had some good results, but don't rest your hat on those results. Just be humble. There could be something that comes out of left field here. Play the patient game. Wait for the market to tell us when to take the next opportunity. So as we divest, we'll comfortably and safely put money back in our investors' pockets. We hope they'll appreciate that. And then
they'll be asking you what's next.
We'll be asking the same question. And I'll be saying, we don't know yet. Wow. And that's a difficult place to be, but that's the honest truth. We don't know where we're going to be. It's the first time in a while that we've gone, I don't know where the next opportunity is.
Yeah, we don't have a playbook written already.
No, we don't.
Is that a good thing? Does it mean that we think there's going to be heaps of opportunities and we just don't know which one we're going to choose, or we don't know that there's going to be any opportunities?
No, I think the former. I think there will be opportunities, and I think you have to be brave enough to recognize that there always are, right? There always are. It's how hard you're willing to look. And what is your relationship with demand, with the reward and risk, as we've talked about? So we want to make sure we protect capital first and then try and generate a return. And are there going to be opportunities that do that? Yes. We just need to be patient enough.
What I've found, Cal, is that there are always opportunities. It's just for those people who don't diversify their strategies and their skill sets in the investment space, and obviously we're talking about the property investment space.
Yes.
That note that there are times where there aren't opportunities, or we shouldn't have taken that opportunity. But if you are across as many segments as possible,
yes,
then there will generally be one segment or a couple that have opportunities that meet the risk-reward thresholds. That's been my strategy since day one, is to try and get across as many markets as possible so that, hey, if it's not great in the triplex space, we can move into the childcare space or the land space. And if the apartment space is too risky, don't worry, we don't have to sit on our hands for 5 years. We can work into the industrial space. Moving those skill sets left and right as they are required is what helps you stay nimble, but what also helps you stay away from those opportunities that were possibly a bit too risky, but you had to take because you had no other choice.
That's right. And that's where we want to stay away from. It would be more important for us to be patient than aggressive. Let's make sure we're using the same framework to assess opportunities, and let's be aware enough that it might not be in our own backyard, right? It could be slightly tangential. It could be slightly different than what we've done before. Let's make sure we assess it correctly, and then we want to protect capital first, and then we want to generate a return. So if we're patient, I think we'll be able to do that. if we're sitting there and the money is, as everyone says, burning a hole in your pocket and you've got to spend it, that dynamic can only create, I think, chaos within our four walls, and we don't need that.
You end up lending to other people at the end of the day, don't you?
Maybe.
Hey, last question. A couple of years ago, you made a fairly public and, in my opinion, brave call to buy and renovate an office asset in the Perth CBD.
Yeah.
How's that been going? You have a great insight for us as to where the office space sits right now and how you're feeling about it.
Thanks for bringing that up, actually. That was a really, outlandish call from us. And I think
There were some eyebrows raised when you did it.
Oh, totally. And look, if we look at ourselves now, I think we were a year too early. So we have had fantastic momentum now. We wanted momentum within 12 to 18 months of buying it, and we're pretty much sitting between 18 to 24 months. So we took that asset from 6% leased. It's now 46% leased. We'll have it at 63% leased within the next month. So look, that's a really healthy leasing program. We've had to wait a bit longer than we wanted to. But what is great is that we're leasing it. Interestingly, we're leasing it above our expectations of rent, below our expectations of incentive, above our expectations of term. So essentially what we're saying is all the metrics that we thought were going to underpin the rental profile for this building are better. It's just taken a bit longer.
I love the candid nature, and thanks for the honesty, because what it does is it's a really good case study, because not many people have tried this in the last couple. Someone's got to do it. Someone's got to try and, hey, let me try and, because people talk about it. Not many people are actually walking the walk when it comes to, hey, let me put my money where my mouth is, refurbish an office, make it better, get some good tenants in what is a fairly maligned, or has been a fairly maligned space for many, many buildings in Perth that have struggled.
Yeah.
But you're showing that with a bit of patience and the right upsizing, I guess you can start to make this a commercial outcome.
Look, I think the commercial outcome here will still be healthy, but we've definitely looked ourselves in the mirror a few times and gone, maybe we're a little bit too early on this, or maybe we could have rolled our sleeves up a bit more and done a bit more heavy lifting at the start. But you know what, we're here now and it's gathering momentum, so we've got to make sure we bring this asset to fruition.
The cool thing about it is that you only learn by doing in property. And so now that you've done this in that space, you've got a unique set of skills, of context, of numbers sitting in a feasibility that you can, if you identify an opportunity that is similar or better, you're actually one of the few people that could act on it with confidence. And that, I think, is more valuable than a lot of the sitting around physios and people who are keyboard warriors suggesting that they would have done a better deal. That context, that experience is all the value of a property investment business, in my opinion.
I appreciate that, Trent. Thank you.
In 5 years, I think you'll be looking back on it and going, overall, it actually has worked out and scaled to, again, diversify your skill set to be able to stay away from those actually risky assets.
Yes. Yeah, that's right. At the time, it was a very sensible purchase, and we bought it at a price where we've basically figured we couldn't lose money. The profits in the buying, as they say.
Far below construction costs and replacement costs.
Absolutely.
Yeah. That probably brings us full circle in this conversation, right? Is that so many assets, the money has been made simply by buying them for less than what you'd replace them for.
Yeah, below replacement costs. Yeah, it's something we're hearing a lot.
Thank you very much for your time, mate. It's really good to get some insights and super candid insights about where some of the more sophisticated property investors and developers are sitting right now in Perth. You don't hear it a lot from people. Most of the guys in Cal's position will keep their cards close to their chest so that no one else gets a sniff. But we love hearing from Cal because we know he's got the runs on the board, and he's also really happy to share his real life experiences about what's been happening for him and humbly moving across sectors when most people would just dig in and wait. So thanks for staying nimble. Thanks for sharing those insights, Cal, and looking forward to speaking to you. I can't believe it's been 2 years. Definitely a lot sooner than 2 years into the future.
Indeed, mate.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!